When it comes to investing, there's really only two options. You can attempt to time the market by sitting patiently, watching, waiting for the perfect time to strike, waiting for the market to present you with the option to buy super cheap stocks right after a market crash. Or you can use dollar cost averaging. Dollar cost averaging just means that you will invest the same amount of money at regular time intervals, regardless of what the market is currently doing. So it doesn't matter if the market is flat, shooting upwards, or if it's currently tanking into oblivion. With dollar cost averaging, you stay consistent and keep putting in the same amount of money at regular time intervals, whether that be weekly, monthly, quarterly, whatever the case may be. Now, you might be thinking that waiting and trying to time the market is a great option, and in theory, it sounds decent at first glance. Who wouldn't want to scoop up some super cheap stocks right after a market crash? But I did a side-by-side comparison of two hypothetical scenarios. In one scenario, investing using dollar cost averaging techniques over the previous 30-year historical time span. And a second hypothetical investor put all his money into the bank account, and then he waited for the absolute perfect time to buy. Now, in this hypothetical scenario, he bought at the absolute best time possible following the three largest stock market dips in the last 30 years. Ironically, in my simulation, the two investors both ended up with virtually the exact same amount of money at the end. Now, the problem, of course, is that timing the market is hard. Really hard. And when I say really hard, I mean it's impossible. There's a few problems at hand with trying to time the market, and the first is that it's impossible to know when the perfect time to buy is. If the stock market drops by 10 or 20%, then that may be a great time to buy the dip, as it's referred to. But the problem is, how do you know when that dip is over? What if the market continues to slide another 10, 20, or 30% more? And the same thing happens when a stock is going up. Take a look at this stock price for a particular company for the years dating from 1998 to 2013. This stock had some pretty phenomenal growth, from a low of around $2 now to a high of well over $300. That's some crazy returns, and you might think that this company is in a bubble and it's time to sell, but in this case, the stock we're referring to was Amazon, and the stock price has continued to soar since 2013, and now it's, $3,500 a share or something crazy like that. Just because a stock has been going up or down for the past few months doesn't necessarily mean that that trend will continue. Even professional stock pickers don't know with any degree of certainty what a stock price will do in the coming months or years. And the other big problem with trying to time the market is that from a psychological level, it's super hard. All of us work way too hard for our money, and as such, none of us want to lose any of our money. When a stock is continually going down, in theory, that's the perfect time to buy, assuming, of course, we believe in the strengths of this company. But from a psychological level, spending money to buy something that has been doing nothing but losing value recently is incredibly difficult. The stock is tanking, the ship is sinking, and nobody wants to go down with the ship. Instead, everyone is panicking and looking for a life raft, looking for a way to sell their investment so they don't lose any more money. The reality is that instead of buying low and selling high, most people panic and buy high and sell low. Most people invest with their emotions. They sell when they should be buying. And likewise, they buy when they should be selling. People will similarly see a particular stock price taking off and skyrocketing, and so they try to jump on the bandwagon and buy into that stock. But all too often, the stock has already made whatever gains it was going to make, and more often than not, it actually pulls back slightly as investors with irrational exuberance had pushed the price higher than what it really ever should have been in the first place. This investing with emotions is probably the single largest investing mistake that people can make, with the obvious exception of never investing in the first place. When it comes to investing, you want to be able to completely remove all of your emotions, and you want to act sort of like a robot, cool, calm, and rational. You want the market fundamentals to dictate your investing, not your emotions. A recent financial audit conducted by the Fidelity Brokerage Account found that between the years 2003 and 2013, during that 10-year period, the best investors, the investors with the highest rates of return, were dead. Yeah, like dead. The accounts that had performed the best were inactive because their owner had passed away, and as such, no new trades were executed. These dead investors were the epitome of removing emotions from investing. They didn't panic and sell when the market dropped in 2008, and they didn't buy into overpriced meme stocks. By staying true to their original course and just holding on to their assets in the good times and the bad times, these dead investors were able to outperform all of us living folks because we were too busy panic selling at the first sign of a market dip. Dollar cost averaging, on the other hand, works not only in a practical level for us commoners that can't see the future, but it also easily allows us to invest on a psychological level and is super easy to maintain and set up. With the method of dollar cost averaging, we completely ignore what the current market is doing. We simply keep buying regardless if the market is up, down, flat, or anywhere in between. Now, yes, this does mean at times we will be buying stocks at its peak price, but it also means that we will be buying stocks during its absolute lowest right after a market crash, and therefore at the best prices. Using this method takes no skill, carries no emotional baggage with it. It's so easy, a caveman could do it. This method works for a couple of reasons. First, it completely eliminates the psychological problem that we've previously mentioned. And because we aren't just buying during a crash, instead we're buying during a crash, before a crash, after the crash, during the recovery, and everywhere in between. We're just always buying. Secondly, because since we're always buying, we are always having all of our money actively working for us, earning interest or dividends, etc. If we instead try to time the market and keep that money safe and secure in a bank until a crash, that money is effectively not generating any real rates of return, earning 0.01% annual sitting in a bank account somewhere collecting dust. By constantly buying and always having our money working for us, that money is constantly earning us those sweet dividends, even during otherwise flat years in the market. So, what's the best way to get set up with dollar cost averaging? Well, I highly recommend the M1 brokerage account for this method. M1 Finance is the only brokerage, at least that I'm aware of, that lets you 100% completely automate your investing. With M1, you can have it automatically pull money out of your bank account on a specific day of the month and have that money automatically invested into whatever stocks, bonds, or index funds you decide according to your predefined investing specifications. So with M1, you can literally set this up once and then forget about it for decades at a time and have it automatically do all the dirty work for you and start benefiting from this dollar cost averaging strategy. If you're interested in learning more about M1 Finance, you can check out this video right here, as well as check out some of the links below. Currently, if you use the link, you'll get $30 for free right after you deposit and start investing with your first $100 in M1 Finance. If you enjoyed this video, consider subscribing, and if you know any other 100% fully automated brokerage accounts, I would love to know about them. So be sure to comment down below along with your thoughts on this dollar cost averaging strategy. And as always, I'll see you all again next time. Thanks.